In this video, we are going to discuss about how the massive foreign currency borrowing by home loan buyers led to financial currency crisis in Hungary. In the wake of global financial crisis, when entire world was suffering from subprime mortgage loan crisis, Hungary, being an open economy, suffered major crisis because of high ratio of foreign currency borrowing. To understand this, we need to go into history of mortgage loan in Hungary. In early 2000, Hungarian government came up with new housing program which resulted into increase in subsidy provided on home loan. During this period, Hungarian mortgage market was stable and there was significant growth in home loan in local currency. Later in 2003, Hungarian government reduced subsidy provided on home loan, and in 2004, Hungary joined European Union, which provided an option to Hungarian home buyers to borrow in foreign currency at cheaper interest rate than home currency. These two factors led to rapid increase in foreign currency borrowing in Hungary.
As you can see in table, before 2004, mortgage in local currency accounted for 98 to 99% of total home loan, and FX denomination loan was only 1% in 2003. After 2003, there was a gradual decline in local currency mortgage loan from 99% in 2003 to 26% in 2008. The FX denomination loan saw a sudden increase from 1% in 2003 to 41% in 2008. Meanwhile, Swiss franc became the most popular foreign currency in Hungary, and about 90 to 95% of foreign currency loan was issued in Swiss franc because of two macroeconomic factors. Firstly, interest rate on FX loan were considerably low, even though deflation lowered domestic interest rate. Secondly, the exchange rate was fairly stable and gradually strengthening against the Swiss franc. This strengthening was due to the Swiss franc being a vehicle currency for carry trade and the foreign being a major trade for carry trade investment.
However, the situation wasn't the same during GFC. Because of risk aversion nature and fear of crisis, foreign investors started selling Hungarian bonds that led the Hungarian government bond market to dry up. Meanwhile, foreigners started to weaken, resulting into fall of stock market, increase in interest rate, and shortage of liquidity. The reason for downfall of Hungary economy was also partly because of its loose fiscal policy, high deficit and external debt, and the huge foreign exchange mortgage portfolio. But this wasn't it. Hungary's central bank used a quasi-interest rate to support the forint, but unfortunately it lost its value, dropping 14% against euro. These all facts encouraged rating agencies to downgrade Hungarian financial system. After September 2008, the mortgage market changed dramatically in Hungary. The weakening of the Hungarian forint increased the mortgage repayments for borrowers with foreign currency loans. On average, such loan repayments grew by 30 to 40%. The majority of Hungarian mortgage loans were variable rate loans, with 85 to 93% of these loans being issued between 2006 and 2008. Consequently, the payment burden increased not just because of the change in exchange rate, but also because the bank increased variable interest rates. These two developments certainly increased the likelihood of payment arrears.
As you can see in the chart, between 2004 to 2008, the value of Swiss franc was around 150 to 165 Hungarian forint. But after September 2008, the value of Hungarian forint started to depreciate. By 2009, the exchange rate increased to 210 and crossed 220 Hungarian forint in 2010.
As a consequence of the crisis, annual new housing construction fell from 36,200 in 2008 to 7,300 in 2013. Real house prices were more than 30% lower in late 2013 than in early 2008, and housing transactions decreased by 40% over the same period. The share of non-performing loans increased from 5% to 20% between 2008 and 2014 in Hungary. The initial response by the interim government from 2009 to 2010 to the crisis focused on managing the fiscal deficit. which was one of the conditions of the IMF loan taken out in 2009. An important element of the fiscal adjustment program was a drastic cut to housing subsidies. The two mortgage interest subsidies and the housing construction grant were repealed. Another important measure was the introduction of a moratorium on foreclosure up to 1 September 2009, which was later extended until 1 July 2012.
Measures taken by government to overcome the crisis. In 2011, the government launched its Home Protection Program, which introduced three main measures to rescue FX borrowers: FX Loan Repayment Scheme, FX Loan Rate Cap Scheme, Rent to Own Scheme. FX Loan Repayment Scheme ran from September 2011 until the end of February 2012 and allowed borrowers who took on Swiss franc denomination loan before 2008, when Swiss franc traded at around 150 to 180 Hungarian forint, to repay their FX mortgage in full at only 180 Hungarian forint, at a time when Swiss franc was trading at 235 to 250 Hungarian forint. Later in 2012, the FX loan rate cap scheme was introduced. Under this scheme, exchange rate cap on repayments was fixed. The exchange rate differential, that is, difference between repayments at market exchange rate and the capped rate, was accumulated in separate account. The expiry rate period was until June 2017. After the expiry, outstanding loan balance was redistributed over loan maturity period, and it was also guaranteed by Hungarian government. Rent to Own scheme was managed by a newly established National Asset Management Company. Under this scheme, National Asset Management Company purchased housing properties with non-performing loans and offered a rental option to the former debtors. It planned to purchase 250 units by the end of 2014. National Asset Management Company paid 55% to 35% of the property's market value based on their original mortgage contract between the bank and the borrowers, and rented them back to the previous owners. Important Supreme Court judgment. In June 2014, judgment was passed by Hungarian Supreme Court in regard to pro-borrower ruling, according to which the practice of exchange rate spread using different rate for buying and selling foreign currency was declared unfair, and hence instructing the banks to instead use National Bank of Hungary official central rate. After this, the Hungarian government quickly passed a new act, according to which the bank has to recalculate the originally used exchange rate spread and reverse the unfair interest rate increase that occurred since the original disbursement of the loan. Once individually recalculated for each and every debtor, banks were obliged to fully compensate borrowers by either refunding the difference or decreasing the future monthly installment to compensate borrowers.
In conclusion, we can say that Hungary's financial situation during the economic crisis was unstable, and the main reason behind it is openness of the country's economy, as 45% of assets of Hungarian companies were controlled by foreign investors, and about 25,000 foreign enterprises are registered in Hungary. But Hungarians did not have any idea that, though borrowing in foreign currency offers some immediate benefits, such as lower interest rates and longer maturities for the non-banking sectors, these loans also carry a significant exchange rate risk. The domestic household sector is unlikely to have any income in foreign currency or to use sophisticated hedging instruments against the exchange rate risk because of lack of hedging instruments, willing counterparties, or deep financial markets. So in order to avoid such crisis in future, Hungary needs to come out of its weaknesses only by bringing changes on its policies and economic practices with comprehensive structural reform in its public finances that includes far-reaching cuts in spending and tax rates and not totally depending on International Monetary Fund or other international authorities. Thank you.